Well, hello, everybody. Welcome to Thursday. Unfortunately, today was a red shirt day. For those of you who haven't watched this very often, red shirt means that the S&P 500, unfortunately, was down more than 1.5%, and it was actually down 2.45% today. Luckily for us, we do have an inverse position in our stock portion of the portfolio, and it's an inverse on the S&P 500, and it went up 2.4% today. One of the reasons we put that in, and it wasn't that long ago, was because the bond market really is struggling to be the parachute that I like. So in a perfect world, bonds for me are a buffer from the stock market volatility. So when the stock market falls, the bonds often would go up, and that would help. Well, today the stock market fell and the bond market fell. Now, the bond market didn't fall as much as the stock market, so that's sort of a buffer and sort of a parachute. But the inverse is in there to kind of get that little run up, and that helped, and it helped us, outperform the stock market today, in our stock portion of our portfolios. And that's a really critical thing. A couple things happen when you do better on down days. Number one, it just makes it easier to recover. If you lose less, you can get back to where you were a lot faster. So that's fairly obvious. But what isn't always so obvious is that if you are losing less in a down day, you probably have things that people are interested in. They're not selling them as fast. So the clean energy piece that we had such a great run with has been selling at a higher rate than the market, including today. And so it's telling you people are, not as interested. Now, that wasn't true. Actually, back in October and what have you, I saw those holding up and doing better. And we bought those and did really well with those. So if you're not falling as fast, oftentimes what that means is that really you've got this scenario where you're holding on to some pieces that people are interested in and are not willing to sell them right now. Still went down, but not as fast as the market as a whole. The other thing that I've noticed over time is that oftentimes those pieces that don't fall as much as the market, when there is a recovery, will bounce back. If you look back to February, March of last year, that's exactly what we did. Identified those pieces that were falling less, rotated into those. We did continue to fall less by a little bit. And then when the bounce came, we bounced harder because, again, there's some interest in those particular securities. So what's interesting, the market right now is this value category. We have three big value pieces in our portfolio, and the energy piece is one of the others, all of which outperformed the S&P 500 today. And what that tells you is that right now, the market is looking at this economic recovery, and they're excited about these stocks that can do well if the vaccine comes out and works and we can get this virus under control. And one of the big advantages, I mean, if you have a cruise line, you've been really struggling to get by. So you've cut costs, pretty dramatically. If you have an airline, you've cut costs. And if all of a sudden the virus is cured and revenue shoots up in an environment where you've just cut a lot of costs, those companies' profits could really skyrocket. And so that's the rotation. This is an epic rotation. I've been doing this for 35 years and I've never seen anything like this, but this is the first pandemic I've ever been involved in that 35-year period. So that's a good thing. So the advantage for me, so when I look at the downturns, to me, this is a time to be calm. It's not time to panic. This is a time to look. The market is talking to us. It is telling us information. I get more information out of days like today than I do out of days like yesterday where the market was up a little bit. And so I can go in and see, and that's what I'll be working on, this evening. What worked? Where should we be? What didn't work? And does that continue to be a problem? And should we be rotating some pieces? So I apologize for the number of transactions that have been coming through just recently. I really do. We don't want to do them either. We don't make anything on them. At least there's no commissions on them anymore, so that does help. But this is a epic rotation that's happening right now where we need to be able to see what's happening, execute the plan. We've been executing the plan. We're in the right spot. The places that we left are doing worse than the places we've come into. And I think we're setting ourselves up very well for some type of recovery. You know, the other part to keep calm about is that over the long term, the stock market goes up. Now, it might go down more, in the short term here, especially when you have this kind of pain that's happened. Sometimes it does come down some more. But again, that's just more information, more things that we can see, and better able to position ourselves for when there is a recovery to create wealth. This is what we did over the last 12 months. And these types of downturn situations, we're doing the right thing. We're going the right direction. We're making the right moves so far. That could change. We'll see what's happening, but I'm really very happy with the portfolio. We've been shrinking the amount of money in these growth type stocks. I had 5 pieces. We got them down to 2. That might go to 0, because they're still following. There seems to be I think all these Robinhood guys are running around right now trying to figure out what's going on, because most of them started investing about a year ago. Um, and all of their experience has been upmarket and these growth stocks. So, this rotation is something that we're seeing, and we're slightly ahead of it. You can see that, we're slightly ahead of what's happening in that rotation. I wish if I could go back in time, there's all kinds of things that I would do differently. But I always like to say coulda, woulda, shoulda is undefeated, right? That is very difficult to really do. So, don't react to predictions. The market talks. It tells us things. It's telling us what's happening. Listen to the market and look at that and react. And don't overreact. So I do what's called incremental reaction. So, I move a couple pieces and see what happens. Is it right or wrong? Okay, good. That was right. The other parts are still not doing well. Okay, I'll move a couple more pieces. I don't want to move, like, I have 8 pieces in my, model. I don't move all 8 at once, on some prediction. So I'm listening to the market, and the market is telling us right now that there is a very, very strong rotation towards these value type of stocks and a rotation out of these growth type of stocks. Now, how long does that last? What have you? But I think it's going to continue for a while, just because the economy does seem to be recovering. We have another piece going on with the bond market where the rates are going up because of this expected inflation from this explosive economic growth we might have. And that's creating some problems for the bond market that we have to kind of deal with separately. Same thing. Listen to the bond market. So bond market's telling us short term is better than longer term. The high yield stuff is doing medium altogether. We'll see how that plays out. But that process of where to go is the same on either market. There's lots of info that came out of what happened today. So I look at that as an advantage. And I hate when the assets drop. We get paid based on the value of the account. So, we want them to go up every single day, but this is an opportunity. So let's take advantage of that. Let's pay attention. Let's listen, and let's execute the plan, which is what we've been doing so far. So thank you very much. And I look forward to seeing what's going to happen tomorrow. This is a very interesting time frame to be listening. Thank you.